know that EGROW Foundation is a research-based policy think tank, and on contemporary issues, we invite amongst the best minds in the world, just not our country, from the world to come and speak to us on issues that are policy issues or those which are vexing the government or policy makers. Today's issue is in the same context. We are talking about the bond market. In fact, developing the bond market has been a challenge for the Reserve Bank of India and the Government of India for nearly 3 decades. We have not been able to do it. Very little research on the bond markets in our country. And when I came to know that Dr. Alok Pandey has done some good research, we invited him. To chair the session today, we have Mr. R.N. Dubey. R.N. Dubey is from the Indian Economic Service, 1984 batch. He has worked at different places, including the World Bank. Most importantly, he was the advisor in the Department of Financial Services, Ministry of Finance, Government of India. With that, I hand over the session to Mr. Dubey, and by 3:30 we will wrap up the session because by 4 o'clock we start the shadow monetary policy. With that, Mr. Dubey, over to you.
Thank you. Thank you very much, Dr. Charan Singh. This is my first session with you with eGrow, and I'm very happy to be here today to chair this session. And I welcome Dr. Alok Pandey. And to briefly describe about him, Alok Pandey is the professor in finance and dean School of Management at GD Goenka University. And he is an expert in area of corporate international finance, investment and derivatives. He holds a PhD in international finance from University of Lucknow and master degree in management from Banaras in the University, India. And he has been holding host of other assignments, and it's good that he's going to make a presentation on bond, which is very close to my heart. And I had dealt with these things quite some time ago. I will come back on that at a later stage. The other speaker is Ms. Sunarita Chaudhary. Ms. Chaudhary is an assistant professor in finance and economics at School of Management, GD Goenka University. Her areas of specialization are international money and finance, security analysis and portfolio management, derivatives, stock market, operations, and macroeconomic theory and policy. She has net certificate from UGC, and she has a lot of industry experience, and she will also be presenting a paper today. And finally, we have Ms. Prabina Rajiv. She is a professor in finance at Vinod Gupta School of Management at IIT Kharagpur. She has more than 2 decades of academic experience and was Dean of Vinod Gupta School of Management from 2017 to 21. Professor Rajiv has authored 2 books, Commodity Derivatives and Risk Management, and Stock Exchange Investment and Derivatives. And she also holds a lot of other degrees and a lot of other experience. So today's presentations will be by Dr. Pandey and Sunarita Chaudhary, and it will be and discussant will be Prabina Rajiv. So I now hand over to Dr. Pandey to make his presentation.
Thank you, Dr. Charan Singh, for inviting us here. The session chair, Dr. R.N. Dubey, discussant Professor Prabina Rajiv, my co-presenter, Ms. Sunita Chaudhary. Now, the logic of this particular presentation is that we have been viewing bond markets, as Sir said, a lot of research has been done over a period of time in other aspects of capital markets in India, but the bond markets are not as vibrant. So Ms. Sunita Chaudhary actually is pursuing her PhD in this particular topic. And when we started working together, she had done some preliminary work into it, and we then changed tracks and looked into some aspects of term structure. And we started talking in terms of what best can we do, which could be addition to the body of literature. So this particular presentation largely is a work which has been done over a period of last 1 year, plus some additional work which Sunrita has done over the last 3 years on this. She has an experience with a financial institution, and she's an economist as well. She knows different aspects of it. So when we decided that we'll identify some particular topic in bond rather than taking the entire bond market space. So this particular presentation, which is entitled as Bond Market Development in Perspectives on and Perspectives on Modeling Term Structure of Interest Rate, Bond Prices and Bond Option Prices, has a kind of a we've divided this presentation in four broad parts, basically. The first one is that the introduction to bonds and bond markets in India. The second one would be models for two broad parts. One part would be the bonds and bond markets in India. The other part would be the models for term structure, bond prices, and bond option prices. So Sunrita's PhD work got acknowledged, and we got two papers out of this recently published in International Journal of Bonds, and not published. I think one is in press, the other one is in final stages. Both have been accepted, and the other one journal is called International Journal of Financial Markets and Derivatives. And these are all journals in the Australian Business Deans Council list, and fairly good journals in terms of their coverage of bond markets and derivatives. And we work together. I happen to be Sunrita's PhD supervisor, not to use a hyperbole, but she is very bright and she has done fair amount of good work on the management and modeling of these. In fact, a lot of data she has used in presentation, in fact, as far as Vasicek and CIR models are concerned. So very quickly, getting into this particular presentation, as far as the idea of bonds are concerned, the bonds are nothing but these are fixed income instruments which have principal and coupon payments. And these principal and coupon payments are based on a particular valuation which the company decides. And the return to the investor often is called yield. And that's where our research begins. The purpose of this particular entire work is to identify a correct benchmark of yield. Just 1 minute. I'm in a meeting, I'll just call you. So what really happens here is that we tried our best that, probably there are a lot of bond models available. Which models are the best fit at a particular point of time, which can attract investors into a market, which can attract borrowers into a market, which can attract people who wish to raise money from a market. And for that, you need a particular yield curve. There are models available. How do you compare it? Which models are the best? That is our perspective on markets. And a yield curve needs to be identified properly. Why? Because if the yield curve is there and people have an idea, then they can correctly identify for different maturities the amount of money as well as the kind of returns they're going to get on it. So in order to arrive at a particular opportunity cost, you need to benchmark, and a benchmark is, again, like in equity markets, you have different benchmark evaluations. Here also there are different benchmarks. Which benchmark you use and how best it is at a particular point of time is often dependent upon the financial health of economy and the macroeconomic parameters. We shall, of course, also look at this idea that why some bond markets do well and why some bond markets do not do well. Now, in a bond market, if you look at the divisions, the basic divisions in a bond market are for the government and corporate. The government, at the government level, now India also, some of the municipalities have issued bonds, which is a very welcome step. So we've got central government securities, we've got state government securities, and we have municipal bonds. At the corporate level in India, what we call debentures, and globally what we call traded bonds. These bonds are issued by companies, and they are often rated by rating agencies, and a strict guideline is issued in order to have them, in order to allow them to trade. Now, the bond market basically has several functions. One is that it helps you identify the opportunity cost of your funds through the yield curve. It allows you not to depend too much on the bank intermediation, and it allows you it allows the government to disseminate, or the central bank to disseminate, its monetary policy. Now, what happens here is that most countries which have developed bond markets have seen fair amount of growth in their GDPs. Japan being an example, which overtly was dependent on banks, but still did well. But even now, Japan also has a thriving bond market, corporate bond market, and they are raising a lot of funds. Corporates are raising is from the bond markets. Now, again, here there can be international funding also using bonds, but in international funding, the problem is that your sovereign rating and the currency risk affects your overall cost of funding. There is some relationship between the banking system and the bond market. If the bond markets are well developed, the banks get affected positively. The evidence from around the world shows. Normally, if the bond markets are not absent, if bond markets are absent or underdeveloped, there's a lot of pressure on banks to fund the needs of the corporate as well as probably sometimes the state governments. And that's where we get into a cycle of non-performing assets. India was into a cycle of non-performing assets. We've been able to identify some measures using which we have reduced them. But the best way would be to reduce the pressure, to reduce the pressure of the banking system. We need to have an active bond market. Now, what an active bond market also does, if it is present, it along with banks, it will allow healthy competition and efficient allocation of capital and discovery of both prices and yields. Now, why bond markets allow efficiency is because the credit quality of bonds is observed very minutely by the players. And when the bond markets are present, those who are looking for fixed income, they have an alternate choice and a variety of choices depending upon what the credit rating of a company is, based on which how much yield someone can generate over a period of time. Now, some of the literature we reviewed during the process of this study, which has been very exciting for me in last 1 year or so, is that, if you look at around the world, people have studied the relationship between banking system and bond markets. And what we divided was, we divided into symbiotic and non-symbiotic effect of bonds on the bond markets on banks. So if you look at symbiotic effects, there's some very prominent effects. One, that if the bond market is present, then you can identify correct interest rates better. So therefore, banks can get an idea as to what and how to price their interest rates for different maturities, whether it is for deposits or for lending. Now, bond markets also help banks securitize their assets. They also allow them a risk management tool through the, the banking system basically thrives on the fact that they invest a lot of money into government securities markets around the world. There's some non-symbiotic effect where, what happens is that if the bond market pays higher yield and better security to the investor, the quality borrowers go out of the banking system and the banks have to take a higher risk. Similarly, if the bond markets become volatile, the banks have a higher rate of interest. Of course, we have seen with the interest rates changing, the portfolio of banks which is invested in government securities or corporate securities, the mark-to-market value changes. So that again is a problem. Now, similarly, another study was on why do we need a bond market, and this was and this offered some of the ideas which now are open to all of us, that the bond markets help you develop a benchmark term structure of interest rates. They give a wider range of assets to savers. They allow the insurance, which are again a long-term investment, which are long maturity products, the insurance products and pension funds. Now they find that their maturities often matches with the bond. India, of course, does not have that. But as we develop our markets, the biggest beneficiary would be the insurance and pension funds. And we now have a thriving national pension system. If I may tell you about the NPS, which was launched in 2004, it has now more than 5 crore. That is almost 500 million investors. We have a very healthy participation in bond markets otherwise also, but the insurance products also are doing well. And of course, with LIC coming into the market with its IPO, we have seen the role of private sector insurance rising, and they'll be benefited in a very big manner if they have an active funded bond market. Bonds also help banks in raising funds, also investing funds. They encourage, if basically you have a bond market, you can develop a bond derivative market, which can help hedging risks. We have been, of course, a lot of researchers have talked about the CDS system, which came into being in India in 2011 onwards, the credit default swap system. Once those products come in, bond become a much safer investment for a lot of people, and the risk management is better. Similarly, if you have an active bond market, you don't need to rely on foreign borrowing, and you can attract foreign investment into the bond market for a longer term basis. The other issue is that one of the studies gave the government perspective of it, that on the policy issues, it said that the government basically can raise funds through bond markets, government securities market to manage fiscal deficit. It can use it for sterilization of capital flows, as we know that when the central bank intervenes into the foreign currency markets, there could be an issue in absence of bond markets, active bond markets, that they are unable to sterilize the liquidity in the system. So similarly, if you look at the benchmark term structure interest rate, it is effectively found out using the bond markets, and they also help in implementation of monetary policies. So again, the objectives of the monetary policy, as everybody knows, is price stability and availability of credit so that the economy can be managed. So these objectives, of course, can be managed better if you understand the term structure of interest rates better. One of the studies by Mohanty and Turner studied the role of government securities markets in the yield curve, and they found that since the monetary policy works now in India through a liquidity adjustment fund which fixes the repo and reverse repo rates, and all this basically, the moment there is an interest rate corridor is created, the central bank operations such as reverse repo, open market operations, all these basically can be affected through an active bond market system and active government security markets. So what happens is that this is now a well known fact, that if you have active government security markets, the transmission of monetary policy is better, because several maturities of both government securities, and if active bond market is present, the prices or the yields that is can be discovered better. So similarly, we had studies, which this point I've mentioned already. So we can always get into it. So now the point is the measures of development bond market. This is an interesting part again, that what basically can be seen as a measure if somebody has to say whether a bond market is developed or not developed. So you can identify some metrics, and this is a wonderful study by Brown and Briones, which says that 5 major factors can be utilized. One is size of bond market relative to GDP, the size of bond market relative to banks, the stable relative size of government and corporate bond segment, percentage of financial institutions, and percentage of bond issuance in domestic currency. So if you collect data on these 5 factors, you'll be able to say whether the bond market in a country is developed or not. Another one, a study which mentioned that if you look at the bond market systems, basically over a period of time have helped in price discovery. If you look at the developed bond market systems, they help in a better price discovery system, which I have repeated earlier. Over a large spectrum of maturity, government securities are available. The banking system is complemented by the bond markets, and of course, if the issuance of bonds is easy, the investors find easy for themselves to park their money. Now, if you look at the bond market system, India or other countries, you can you identify that 3 major factors are responsible for the growth and sustainability of the bond market systems. One is favorable macroeconomic conditions, fiscal deficit, inflation, all other financial health parameters. The market infrastructure for facilitating trading, clearing, and settlement, and a regulatory framework which can oversee the issuance and process of bonds, secondary markets, trading of bonds, and transparency and timely disclosure of the issuers. And we, for the corporate bond markets, we lack somewhere in each of these. Of course, the market conditions are favorable. Let me show you some of the data on it. The financial conditions, largely, this is 2020 data, and this is courtesy the CRISIL yearbook on bonds. Largely, the condition, the green boxes are the favorable parameters, the yellow boxes are the neutral parameters, and the red boxes are the unfavorable parameters. Now, what we've seen here is that most of the parameters tend to be favorable for an active functioning corporate bond market. Now, for the bond market in India, there are several studies which have been done, and they found that there are structural bottlenecks, there were problems in terms of trading, secondary market issues, and one of the major ideas, inefficiency in identifying the right term structure of interest rates. You know, the inefficiency gets in because you did not have a right model. We did come to a point where the Nelson Siegel Swenson model was used by CBIL over a period of time, and now we are saying that some other models can also be considered. So what we have seen that all these factors have been documented well as to why the markets in India have not grown as much. So you look at the over dependence on bank lending, you look at structural bottlenecks in the market, you look at the weaknesses in institutions supporting the market, and you look at unfavorable macroeconomic conditions. Now, one after the other, this study was 2004. Each of these factors are being taken care of. And as more research happens into it, probably we'll find a good solution for it. Now, Fleming in 2016, along with other authors, identified why Indian bond markets have developed well. What he found that the auction process, of course, the government bond market in India is fantastic, doing very well, highly efficient. And they have a negotiated dealing settlement system, an order matching platform, an over-the-counter market, and of course a debt segment. So auctions done by Reserve Bank of India have been very effective, and the price discovery mechanism also is very good. The CCIL, of course, has that NSS curve which it develops. They have all the details. They give it on a daily basis, on a real-time basis, or at the end of each day. So the information is available. Now, if you look at the relationship between corporate bond market and government bond market, if the government bond markets are good, the chances that you will develop a proper corporate bond market over a period of time are high. And we have seen that the presence of, in the literature, that the presence of government security bond market and the steps taken by the government under Honorable Governor Y.V. Reddy in 2007 onwards, in the first decade of this century, what we found that several of the steps during those regimes on the bond markets, there's a wonderful article, I think I read, a speech by Y.V. Reddy, who had encapsulated all these steps taken by the government to develop it. That had a very strong effect on the development of corporate bond markets, and that we collected some data on it. So the fact is that, the reason why this corporate bonds market was small, that, high cost of issuance, very stringent disclosure norms, and of course, both supply and demand side factors were responsible for this. So supply side, as I said, high cost of issuance and stringent disclosure norms. On the demand side was, of course, that several of the players, the financial institutions, failed to generate demand for these corporate bonds, since they don't qualify as eligible investments. Now, it has been said, I think now government is taking due consideration on this particular point. Of course, over a period of time, we have created an FPI, and there's some more work at the end of the presentation, which Sunrita would discuss. The foreign portfolio investment, the impact of it on the market, which has also been very positive. Now, the corporate bond markets basically tend to be, in India, people tend to hold these to maturity. The secondary market is not doing as well. And we hope that over a period of time, the liquidity would come in as, we have better identification of term structures in the corporate bond markets. The issuance norms would be eased. The credit quality and the mechanism to measure credit quality would be strengthened. And all these factors would help us. Now, let us look at some of the data based on bond markets, in primary markets of bonds. So if you look at it, there's a fair amount of growth in terms of total state government bond issuance on the right-hand side of your table. If you look at the overall issuance in terms of rupees crores, there's hefty increase from 2015, 14, 15 in the government bond market. In the GOI bond market, Government of India, again, there's hefty increase. However, the total the issuance in terms of corporate bond is what is not very healthy. It is still around 4% of GDP. Whereas, if you look at the government bonds, they are almost 95% of the GDP. Now, if you look at the capital market issuances by corporate sector, over a period of time, they have seen an increase. Equity, if you look at the equity shares, They definitely are, a big idea now with more than 8-10 crore people who are investing directly into the equity markets over a period of time due to COVID impact. We are seeing now a growth in the debentures market also. And over the last few years, there is a growth in it. The capital market issuance, which picked up early part of 90s, through the equity, has not reflected as much in the bond markets, which is a point to be taken care of by the regulators. The secondary market of bonds, as such, as far as is concerned, if you look at it, the transaction levels, the secondary market trade in corporate bonds. This table defines over a period of time 2014 to 21 the outright transactions in GSEC, state government security and treasury bills, and the repo transactions in GSEC, state government securities and treasury bills. So we see that the levels are higher again in the government bond markets as compared to corporate bond markets. This particular table explains the secondary market transactions in bond, the outright transactions. The table, it is the extension of the table. The pink bars are the outright transactions in GSEC, government security and treasury bonds, whereas the blue lines are the secondary market in corporate bonds, and the gray lines are the repo transactions. So you can see that repo and outright transactions in GSEC are higher. The effectiveness of the bond market is often explained in terms of the bid-ask spreads. And if you look at the data, we've got data on spread, we've got data on spread range, and we have spread basis points over a period of time. So this reflects the liquidity levels in our markets. And we've seen that the liquidity levels over a period of time have been slightly volatile, and of course, that has an impact on the spread. The maturity pattern of the Government of India rupee loans over a period of time, if you look at it, this is one of the indicators. Remember that most of the data which I'm showing you are the indicators of the development of bond markets. So what we have here is the maturity pattern and the total amount which has been raised over a period of time, under 5 years, between 5 to 10 years, over 10 years, and of course the total amount which has been raised here. So look at the data from 2014 to 2021, the total amount has risen fairly. The maturity pattern, however, majority around 30% is under 5 years, around 30% between 5 and 10 years, and which is a heartening sign that the maturity pattern now over 10 years is rising. Similarly, the ownership, of government security. So a wide range of players have gotten. We still need to expand the range of government security. We have now the pension funds coming in a big way, which will invest. And in fact, anybody who has an NPS account would know how important, because 40% of the NPS post 50 goes into the government securities and 40% goes into the government corporate bonds. Only 20% goes to equity. So now NPS and EPFO would become a major. So we have commercial banks, you have non-banking institutions, insurance companies, mutual funds, cooperative banks, and of course other financial institutions, corporates, etc., foreign portfolio investors, provident funds, Reserve Bank, and others. Now this is a data again from CRISIL yearbook, now 21, which says that if you look at the expected corporate bond supply by 2025 is going to be in the tune of 65 to 70 lakh crore rupees. Whereas if you look at the demand side of it, it's just 60 to 65 lakh crore rupees over the period of 4 years. Majority of this is actually going to be into the national infrastructure plan and the funding which is required to fund the infrastructure. So as far as the demand side is concerned, we've got mutual fund, insurance, retirement funds, banks, etc., who participate in it. And as far as the supply is concerned, we've got, of course, the infrastructure companies in a big way. We've got corporates, we've got NBFCs, banks, and other related bodies. Now, the point is, as we go, there is a shortfall of 5 to 10 lakh crores in terms of demand. In terms of, there's a mismatch in demand supply, and there's a shortfall of around 10 lakh crores, 5 to 10 lakh crores, which will happen between demand and supply. And that is where we need to identify to develop the methods. Now, here again, very quickly, we'll say that why yield curves. I'll not take much time because we have only up to 320. for this. So I'll basically skip this particular part. Importance of yield curve. It is a very important idea. Why? Because it helps you understand for different maturities the kind of interest rates or returns you will generate on your investment. A secondary market, if the yield curve is properly found out, the secondary market becomes becomes active, and the liquidity levels in the markets rise. The CCIL, the Clearing Corporation of India Limited, publishes ZCYC using the NSS model, and this is a graph of their data for last from April 14 securities to April 5, 21. Now, similarly, this is the Financial Benchmark India Private Limited, which publishes, and that is where now I'll hand over. Another important development in the bond market is presence of bond indices. Now, what bond indices do is like what Sensex does and what the commodity derivative indices do. They basically give you an idea as to how you are doing, how the return is happening. So if you look at the return data, this is something which is for every bond investor a very attractive sign. The year-on-year return over a period of time between 14 to 21 is approximately 10.17%. Initially, it was high. For 1 year, it was low. But yes, the year-on-year return on the total return on the bonds is pretty high. And this is a welcome sign for all investors. So we are moving in the right direction. We have the CCIL bond GSEC bond index, which is also now available. So now I think I'll hand it over to Sunrita Chaudhary for giving a quick idea on the models for term structure of interest rates, the bond prices and bond options.
Thank you so much, sir. Very good afternoon to respected Dr. Charan Singh, Mr. R.N. Dubey, Professor Dr. Prabina Rajiv, and my guide, Professor Dr. Alok Pandey. So this presentation is basically a part of my PhD work on yield curve modeling. So without wasting time, I shall straight away move on to some of the research questions which the study tries to address. Does India offer a well-functioning market for government security and corporate bonds? And do we have the scope to structure or to create a benchmark term structure of interest rates? Sir has already addressed these 2 points. So I straight away move on to the third, fourth, and the fifth point. As in, what scope do we have to construct the term structure of interest rate by estimating the parameters of some of the term structure interest rate models? How can we use these models to price derivatives, bonds and their derivatives? And can they be used to forecast the term structure of interest rate? So this part basically talks about the equilibrium model. We also have another category of models which are called no arbitrage models. So we also test a no arbitrage model for the same issues. And lastly, we see what is the linkage between yields and macroeconomic parameters. The first question is, why do we need a term structure? We need it to price securities, bonds and bond derivatives, and also for monetary policy making. Now, why do we need a model then? We can straight away take the yields from the market and construct the yield curve. Models, because we need prices of zero coupon bonds for all maturities in order to have a smooth curve. And the market doesn't give us all the zero coupon bonds, prices of all the zero coupon bonds. So what we need is we need to construct a term structure of interest rate based on models. And then, so what we do is we take a model, we estimate the parameters of the model, and based on the observed prices in the market, and then we use the model to price, to create the term structure and to price assets and their derivatives. Now, theoretical models on term structure finds its base in a vast literature of asset pricing models. I'll not go too much into the details, but the main points of these models are that assets, as we know, they have future cash flows, and we value them on the basis of discounted value of these cash flows. Now, the main proposition of these models is that there are random shocks or stochasticities built into the asset prices. So, so basically, the price of an asset is not just a plain discounting of future cash flows, but we have to find out the expected value of the discounted future cash flows. So the question is, how do we build in the random shocks into these models? Now, traditionally, what we have seen is the cash flows of an asset were considered to be random in nature, but modern theory, it suggests that it's the discounting rate which is random in nature. So we build the models accordingly. Okay? So the question is how we incorporate the stochastic or the random element into these models. Now, if we had to look at the entire term structure, and we also had to take into account the randomness, we have to have, we should be able to consider the risks for each maturity, and that is going to make the models very complicated. So empirically, what has been observed is that usually the yields tend to move together. So what we do is we identify a few factors which describe the entire yield curve. Okay? And then we create a model based on these factors. And these factors are considered to be stochastic in nature. So what can serve as a factor? One class of model uses a very short-term interest rate to explain the entire term structure. And so just a little bit of a technical part, short-term interest rate is basically a stochastic interest rate which is going to change every period. And so if I invest 1 unit of a currency at the beginning of the period, by the end of the period, it's going to accumulate to a certain amount based on the rates, how they move over a period of time. Interesting part is that prices of assets can be expressed in terms of this short-term interest rate. That is where these models come in handy. So we build in the stochasticity in the short-term rate, and then we try to explain the entire term structure based on the short-term rate, and also calculate bond prices and bond derivatives based on the short-term rate. So there are two classes of stochastic interest rate models. One is equilibrium models. These models are calibrated on the basis of certain equilibrium conditions in the economy. And the other class of models are arbitrage-free models. These category of models, they are calibrated such that the term structure that the model gives and the term structure that exists in the market at that point in time, they should match exactly. So once calibrated, both equilibrium models and arbitrage-free models can be used to price bonds and derivatives, and of course to model the term structure. So I'm sorry, there are two terms which are missing. It's basically a volatility term. So what we do is, what literature does is, it shows the change in interest rate, the short-term interest rate, as a diffusion process. And there are two parts of the diffusion process. One is a drift and the other is a volatility. And together they decide or they define the movement of interest rates over a period of time. Another very important factor which comes into the modeling of the term structure is the risk premium. Some models, they assume that the risk premium remains constant over a period of time, and some models, they allow it to change over a period of time. So what we do is we look at two very prominent equilibrium models which are used in the term structure of interest rate literature. One is Vasicek and the other is CIR, or Cox, Ingersoll and Ross model. Basically, these models, they explain the diffusion process of interest rate through a process called Ornstein-Uhlenbeck process. Now, I'll simplify it. Basically, this process has two terms. One, which is called a mean reversion term, and the other is a volatility term. So what do we mean by mean reversion? The economy will identify a long-term average interest rate, and the moment the actual interest rate moves away from this long-term interest rate, there is going to be a reversion towards the long-term rate at a particular speed. So what we have done is we have calibrated the Vasicek model and the CIR model based on market data. Now, this graph out here, you might question, how can one interest rate explain the entire term structure of interest rates? The graph out here shows us that the short-term model, the short-term interest rate is actually, it guides the yields of other maturities in the interest rate. So it gives pretty meaningful results if you want a simple model to price bonds and derivatives. So unfortunately, there's very little literature on calibration of these models. There was one study, very prominent study, which was done in the year 1997. Post that, we do not find any significant contribution towards literature. The method which is used is maximum likelihood estimation, assuming that the movement of interest rates is it's normally distributed. So what we have done is we have used call money rate as the short-term rate, since it portrays the movement of short-term rate in the economy. And we have the data is from 2000 to 2021. And what we have done is we have calibrated the model. By calibration, I mean we have to estimate the long-term average rate, the mean reversion speed, and the volatility. So we have calibrated the Vasicek model and the CIR model, and we have also calibrated an unrestricted model, which doesn't create any restriction on. So the basic difference between Vasicek and CIR is that in Vasicek, the volatility is not dependent on the interest rate. In CIR model, the volatility is dependent on the interest rate of the economy. It's dependent on the square root of the interest rate. So what we can show is, what our findings are, is that both the Vasicek and the CIR model, they perform better than the unrestricted model. And between Vasicek and CIR, Vasicek model represents the term structure better. And by mean reversion, the mean reversion speeds are different for the two models, slightly higher for Vasicek model as compared to CIR model. So this is what the simulation path is going to look like if we calibrate the model. One thing to note is that Vasicek model allows interest rates to be negative, whereas a CIR model prevents the interest rate to be negative because of that volatility being dependent on interest rate. So how do we explain whether a model is a good model or not? First, we have to fit the existing term structure in the market. As I need to be able to predict the bigger term structure, and we also need to see how far these models are used by ones. So this study is, it ends, the period of data ends at August 30th, 2021. So we have taken the benchmark curve, the par yield curve, as published by FBIL. We have bootstrapped and found out the zero coupon bond yields, and we have plotted that. The orange graph gives us the bootstrapped zero coupon bond rates, and the blue line basically gives us the term structure given by the Vasicek model. One interesting thing to note is that as we increase the volatility, the market risk premium, the fit becomes better. So at 20%, we have a fairly good fit of the term structure given by the model and the term structure which exists in the market. These are the projected graphs. So we can project we have created a 3 months, 6 months, 9 months, and a 12 months projection. We have to keep in mind that there's a randomness in these projection curves. Okay, so it will keep on changing from time to time. Now, based on the model, the calibrated model, we have tried to price a 10-year government security bond. It's a benchmark which is used for many transactions in the economy. The market price as on 31st of March was 99.15, and our model price based on estimated parameters was 100.95. The fit becomes better if we increase the mean reversion rate and if we increase the risk premium. We have also used this model to price options, and the price of a call option works out to 1.07. I'm not showing you, I mean, the calculations have a very, intense spreadsheet as a backdrop. I'm not showing it in this presentation. I'm just keeping it simple. So this is this is how we have used the equilibrium model to show whether it can be used for term structure evaluation and for pricing. The other model that we have worked on is the no arbitrage model. And here again, we have calibrated a particular model called Black, Derman, and Toy model. This is again a one-factor interest rate model. And the calibration here is done on the basis of a binomial tree. So what we do is we build a binomial tree. From every node, we have an up state and a down state, and how the interest rate is going to move is again going to be defined by the diffusion process given by the model. So using this model, again, we have priced a 10-year security. It has worked out to 98.99, close to 99.15, and the price of a call option has worked to 2.20. So one thing that we need to note is that the prices are different. And the studies have pointed out that unless we standardize the measures of market risk premium, unless we standardize the measure of volatility, mean reversion, and the long-term average rate, the results are going to be different. The point to note is that these models now give us the opportunity to arrive at a benchmark term structure interest rate. Only thing is we need to standardize the models. We need to understand which model is best suited for the economy. And this is also important. The study is important because at present we are allowing FPIs to invest in our country, and FPIs would definitely look for instruments to hedge their positions in the market. So the bond market option is the option in bond market is at a nascent stage. So we need to standardize the pricing formula for that is to be used for the pricing of bond options. Another part of the study looks into the linkage between macroeconomy and term structure of interest rates. Now, this short-term interest rate that we are talking about actually forms a very interesting link or important linkage between the financial world and the macroeconomic world. Previously, we had different models being used for the financial world and different model for the macroeconomic world. But the 2008 crisis has actually shown us that the disturbances created in one market would have a great impact in the other market. So therefore, there is a lot of focus now on macro finance modeling of yield curve. So what are some of the macroeconomic variables that affect yields? We have output, inflation, fiscal deficit, call money rate, exchange rate. Now, over and above these variables, we have also incorporated the effect of FPI in debt. So we know that post 2014, there's a lot of thrust in investors, in attracting investors, foreign investors into our debt segment. So now what we usually expect is that international capital flow would increase the availability of funds, and this should reduce the cost of capital in the economy. And of course, that would encourage investments. So our focus here is to see whether it actually reduces interest rates or not. So we are following a study by Warnock and Warnock, which was conducted in 2009, based on the US economy, where they were trying to see whether change in international investments actually affected interest rates in the economy. So we do find some interesting results. The FPI in debt to GDP actually affects the interest rate negatively, which is expected. But in certain maturity segment, it is significant. In certain maturity section, it is not. Apart from that, we see call money rate and long-term inflation expectations. They affect yields. Fiscal deficit, on the other hand, do not have any statistically significant effect on yields, which goes in line with findings by other studies. But as we pointed out, FPI it has a negative impact on yields, which is good. It is going to help in bringing down the overall cost of funds in the economy. Of course, we need to keep in mind that the sterilization effect or the sterilization effect should not take the effect on yields in the opposite direction, which they might do at certain points in time. So that is pretty much what we have done. We've also done some vector autoregression analysis, where again the studies have found out that there is not very meaningful improvement in the model for forecasting of yields when we incorporate macroeconomic variables into the yield curve models. So basically, what we are trying to our work, what it would do is it would be a major contribution to the empirical research on application of interest rate models in the Indian context. It would actually encourage wider use of these standard models which are used elsewhere, like the equilibrium models and the arbitrage models. Of course, we need to standardize our measures of volatility, market risk premium, as I pointed out, and there should be a better linkage between interest rates and the macroeconomy as we become more matured, an economy and a market. Okay, so with that, I'm going to end my presentation. We're now going to take some questions.
Thank you, Sunita Chaudhary. Thank you very much. Very good presentation. I mean, I liked it very much. Now I will ask Dr. Praveena Rajiv to make some comments. But before that, I would also request Dr. Pandey, because he gave a very good snapshot of bond market. And but you know, among the measures, among the reasons for not development of corporate bond market, I didn't find mention of this crowding out effect, because you know, lot many people talk about crowding out effect because of too much of government bonds being issued, so that the space for the private bonds is not there. So maybe you can answer after Dr. Praveena Rajiv has spoken. Okay, Dr. Praveena Rajiv.
Yes, thank you. It's very, very fascinating to hear. In fact, I learned quite a few things listening to this presentation. But my question is that Reserve Bank of India, Government of India is doing, you know, a lot of committees, lot of initiatives to strengthen the India's corporate bond market. But you know, the result is very much we are able to see that it has not yielded the result what Reserve Bank of India or Government of India wanted. Now, through your research, what do you propose that what needs to be done to you know, make this market more broader and more you know, depth should be more trading volume should be there, more issuance should be there?
I think I'll first take this point, and including the point which was on crowding out the private investment. The basic idea of developing any particular market is that we should have liquidity, we should have depth, and we should have over a period of time a wider market participation. So what probably has happened over the last 20-25 years, a lot of focus has been given on the equity side of the market, and a lot of focus has been given on the bank side of the market. The answer to both these questions by Dr. Dubey and yours are actually linked. The idea is that people tend to go to those places where it is easy for them to borrow. Banks made it easy for people to borrow, and bonds, we made it difficult for people to issue. Now, in the absence of credit derivative segment, which was there in other credit default swap and other derivatives which are on the bonds, we were delayed in terms of developing these equipments for risk management also, these instruments. So what has happened over a period of time, that the right infrastructure was not there for bond markets. The general focus, suddenly when there was a demand for credit in 90s and say in the early part of the century, the whole idea was that we let banks invest in government securities and probably sometime in bonds of the corporates, but they would rather lend out money to the businessman. Now, the focus is that credit rating systems, although they were good in 90s, they did develop well and they are now picking up. Had the focus, like I remember the story about National Stock Exchange, how it was created. When Mr. Ravi Narayan visited Sweden and came back, and he was able to start a new public sector company, National Stock Exchange of India Limited, and screen-based trading happened. So, there are 2-3 things: absence of secondary market, absence of, so presence of too many stringent norms for issuing bonds, the price discovery mechanisms virtually absent. So all these basically came together to ensure that bond market didn't develop. Now, majority of these factors have been taken care of. Now, if you look at it, some of the points which I had picked up while in this particular research, like some of these things are like now the government is being asked to revisit the rating limits for insurance and pension funds. Now they've been told to promote the expected loss scale ratings, develop say CDS market, which is the credit default swap market, in a bigger manner. It has not picked up as yet, and that's where this was interesting when we started working on bond options. So we said that probably later on we can extend the study to something like on CDS and the performance of CDS as well. The foreign portfolio investment has not been it was picking up, but again it has fallen in a way. So a bond guarantee fund is missing. There's several other suggestions which have been given to the government again and again, and of course one of them was creating the right benchmarks. So we have now, this research is right, basically saying that if you create several benchmarks, then if I am an investor, I'll not depend only on CCIL to tell me as to what the zero coupon yield curve would be. Like in an equity market, I've got 10 different ways of valuing an equity, and I can identify 10 different ways and take a weighted average as to what the price of the equity should be, which I buy. So similarly, in case of bonds, yield is more important than price. So if I know several models of yield curve, I can actually come to terms with an idea, no, this could be the best and this could be. So I think, we hope that over a period of time, the government would take into consideration all that which has come to it through different forums. We also are part of that. Mr. Dr. Charan Singh, this wonderful forum of IGRO has again, this is a way of disseminating our information about bond markets. The reason I got interested into it was the entry of pension funds. If you look at it, majority of the investment in these bonds was only by banks, government security by banks, corporate bonds, AAA rated banks. Now, what has not happened is that the wider participation of public was not happening. So as you have number of people coming in from the pension fund side, as the numbers grow, this would become a very solid market, and probably it would, as I said in one of my data sets, that bond issuance in corporate sector is only 4% of GDP. It can easily go up to 30%. Like Japan was a bank dependent market, but Japan now has around 33% of corporate bond issuance of the GDP. So let's hope. And Sindhuda, you have anything to say on this?
He had asked a question on crowding out of. This particular slide, it talks about the crowding out effect also. So there are actually two opposing views on how the government security market affects the corporate bond market. Yes, traditional economic theory tells us that growing fiscal deficit will lead to crowding out of private investment. And we have had periods of high interest rates when it discouraged private investments. But there are studies which have also shown that the government security market, the infrastructure that is created through this market, and most importantly, the benchmark that the government security market gives us, the benchmark yields, that serves as a good support for the corporate bond. So because pricing of corporate bonds is very important. The risk element should get properly reflected. And for that, we need a good benchmark. And I think that is where the government security market helps.
Another idea which comes here is that, the more you fund your fiscal deficit through issuance of government security, the more the yield curve shifts, upwards. And this becomes, difficult for the corporate sector. The interest rates would go up, and the corporate sector would find it very difficult to actually, issue bonds at, higher yields. So that is what, again, one of the reasons why the markets did not develop, and not the and the government, which is 95% of our bond markets are actually government bonds. The government took the market away. So I think somewhere a balance has to be drawn. But again, a lot needs to be done in terms of the issuance part, the growth of secondary market part. I think the best way out is that having organized investment from mutual funds or these pension funds to get into it.
So basically, you are agreeing to this crowding out effect. Basically, you are agreeing that because of government issuing too much of papers, the private sector is unable to, the private corporate bonds are not developing. Another issue related
Yes.
to this is, this, there is preference for unsecured papers, preference for secured papers. We don't have, if you look at the market, I think almost 60 to 70% is secured papers only. Unsecured papers are not there. But for a market to develop, we need more of unsecured paper, because only when unsecured paper is there, then you have to do that calculation. The stream of incomes is not defined right in the beginning, and that will help in developing the market. So, what are your views on this?
The whole idea of, sir, this whole game of issuance of bonds is dependent upon the entire mechanism of who rates these bonds. You said, if there's secured and unsecured, secured versus unsecured. So, what really happens is that the mechanism, if it improves and the credit rating system improves, I think this problem can be taken care of. That is what I feel here. If we have right credit rating system, the problem here is that when junk bonds enter into the market, high yield bond enter into the market, often public gets drawn to them, and that is where we get in some real issues. So I believe that if you look at this idea of secured versus unsecured, the idea of ratings is important, the idea of issuance norms is important, because you can't be very sure that if you allow a large number of corporates to issue securities, then the money of the investors would be safe. That is the other question.
Okay. Yes. Dr. Prabina, you wanted to ask something?
Yes, there is so much of discussion about equity, mutual fund in the popular media and all that. Would it be that a lot of people are not interested to or not aware of it, this investment opportunity, because there is lack of knowledge or lack of information in the popular, media, TV discussions? And what's your view on?
I think what I felt when we had long discussions on this in last 1 year, I and Sundrita, as to why people stay away from fixed income market. I remember Percy Mistry wrote a report in 2007 on Mumbai as international financial center. In that, he mentioned this idea: why do we not have a fixed income culture in this country? Now, one part is that Indians by nature are afraid of numbers. It is rare to see, now, I should say this publicly, but my daughter scored 100 in mathematics 2 years back in a 10th exam. And that cleared my concepts that, that this country, children, if they are raised in a particular manner, in a logical manner, they can think more about numbers. So what happens that there is a lack of awareness about numbers. Everybody looks at the investment from the point of view in terms of, the growth of the size of that investment over a period of time, which is, and in fact, in fixed income, what really happens that the asset itself does not change in price. The principal remains the same, whereas you get a fixed income. Whereas the lure in this market is that you invest in real estate, the prices would grow. You invest in equity, the asset itself would, increase in size. So, one way was that people were, number one, afraid of doing the calculations, and they were unaware of the idea of coupon versus yield. And a lot of people never understood that yields actually, if you have an active secondary market, you can have a higher yield if you sell the bond in between. Again, the bond trading infrastructure was not available. But the other part also was there. People often feel that I invest in a bond and I'll get this money back, only some income would come. Whereas in equity, my stock price, and then the media glamorized the equity market. The media glamorizes the real estate market. Probably there are ulterior motives. There are financiers and there are people who fund these programs which come on television and are on newspapers. So bond market basically was the poor cousin, where people did not understand it much initially in terms of numbers. Then they got confused that, oh, I'll only get my money back. Whereas in a equity, I'll get dividends, but my principal also would rise. The whole asset in terms of quantum would rise. In real estate, I'll get rents from my property, but the price of property would also rise. So in a growing economy, I believe we are on the same page as all developed countries. We probably are moving into the right direction with the introduction of large pension funds, where they can only change the way people invest. And now people come to us and ask us, sir, what is this? What is this G and what is this S in the NPS? So I think, these are some good times probably for the fixed income security markets. With FPI coming in, I think within next 7, 8, 10 years, we will be in a position to have a better, bigger, market for these funds.
Sir, do we have some time? I am Mallikarjunappa from Central University of Kerala. Sir, can I?
Yes, please ask.
Yes. When we look at the way the corporates are borrowing, over a period of time, we have seen that corporates are becoming shy of borrowing. The reason is, now, if the default on payment of interest or the principal or both, we have the IBC which came into existence from 2016 onwards. Corporates are becoming increasingly afraid of IBC and then insolvency proceedings, and therefore they want to avoid borrowing through the bond market. What is your take on this?
So this is a moral, this is the question, which is the moral hazard part. So what really happens is that bond financing is a kind of a loan, which is a kind of a contractual obligation between the buyer, individual buyer, and the company. Now the bond issue process is regulated strictly now by Securities and Exchange Board of India. We are talking about regulating bonds through credit rating agencies. We are asking to create a secondary market infrastructure for bonds. Now, we are asking for the expected loss ratings. We are asking for the derivative segment available on bonds. Now, this is the first part of it. This would enthuse the investor to buy a bond. Corporates also have a responsibility. Now, if you must have seen, one large Chinese company has been defaulting. Sri Lanka as a nation has been defaulting. Pakistan as a nation is on the verge of defaulting. So bond markets, you need to be careful as to who is allowed to issue a bond. Bank funding, the reason NPAs were created was only why, because the corporates took the loans and did not return to the banks, and banks basically survived because of the high savings rate in the Indian economy. And everybody in India, people treat their savings account also as a fixed deposit. They don't withdraw money even from their savings account as such. So that's why they have those flexi deposit schemes. So what I'm saying is that the idea of corporates being shy from borrowing is more an issue of moral hazard on the corporate rather than the system. It reflects poorly. I believe that the corporate should go to the bond market after a rating done, get the investment of the, it should be a particular investment where the investor should feel secure with the company. Let me tell you, Reliance has been raising international funding since 1993. And they've been raising very large amount of funds, even 100-year bonds, and they have done a good job till date. So there are companies which are good and people would invest in them. But this is something where, if a company does not have faith in its own capacity to repay, then it should basically not play with the investors' money in the bond market. And then they should also not be given a motivation to borrow from banks in absence of availability of the bond option. They shouldn't go to a bank just because they know somebody in the banking system, to get a loan sanctioned.
Okay, thank you. Thank you, Dr. Pandey. I think, Dr. Charan Singh, do we have time or should we conclude?
Actually, we have run badly out of time.
Okay.
But the session was so interesting and so gravitating, and the topic was handled so very well by both the speakers and the discussant, and of course you, Mr. Dubey, that we were all fascinated. I didn't realize it's 3:43. 4 o'clock, we are starting the shadow monetary policy.
Okay.
So I do not know if the discussant has finished her, Madam Prabina Rajiv. If she wants to take a minute or two, then we should be ready to wrap. Otherwise, I'm ready to close. But I think I do not know.
No, I don't have anything else to share. As very rightly you said, it has been a very, very interesting, not only the quantitative side, also the logical way of presenting and relating the whole big picture of the bond market and investors' interest is very, very fascinating.
Yes.
Sir, just can I take one more minute since this example of Reliance Industries was brought in? At one time, Reliance Industries had 3 lakh crores as its, debt on the balance sheet. But Reliance itself has become highly jittery now, and they have been reducing the amount of debt on its balance sheet through the stakes. Say they are selling their stake and then trying to reduce the amount of debt. So if Reliance as an industry is leading this type of an example to reduce the debt, how do you expect the bond market to develop through the participation of the corporate?
I'll tell you, sir. I think again the idea is if you find cheap to raise money through equity, you would never go to bonds, because in case of bond, you have an obligation to pay on a regular basis to the investor. The money, the way it has come in the equity market, this has ensured that lots of corporate basically have moved towards the equity side. But let me tell you, in the equity side also, it's not all easy. We have seen all the issues which came last year now being trading at discounts, including the LIC issue. So let me tell you, sir, the idea is that this bond market has to be for the responsible investor. The Reliance became big only because of the bond money they raised in 1990s from a very developed market, United States of America. So somewhere I think we can have an active bond market in India, and probably we'll have global investors borrowing from India.
And not everyone would be
Thank
able
you,
to
thank you,
manage
sir.
the country risks also. Reliance is a big player.
Yeah.
Small corporate wouldn't get the opportunity of investing in international or borrowing from international markets.
I think big corporate are bulk of their fund requirement is coming through their own internal resources. Almost.
Yes, another reason. Another reason. Yes.
Yeah, 30% to 40% is coming from their own internal resources. Then new equity, that share in fact is falling. It was around 17% in 2001. It has come down to almost 13-14%. So equity segment is now declining, and bond is not increasing. That is a different matter. Bank loan is increasing. Somehow or other, our reliance on bank is not reducing, which needs to be taken care of. I think bond market must develop so that our reliance on the bank sector should decline. So good, very good presentation. In fact, I have lived through all this. I joined Ministry of Finance in 1992, when all these things were happening. Those days, even interest rate on debentures were decided by Ministry of Finance. There was an office called Controller of Capital Issues, you all may be knowing. They used to decide the price of debentures. So we have traveled a lot from what it was there in early 1990s, and still there is lot many things to be done. So thank you so very much, Dr. Pandey, Dr. Ms. Sunireta Chaudhary, and Dr. Praveena Rajiv. Very good presentations and very interesting discussions too. And now I hand over to Dr. Charan Singh for his final concluding remarks.
So I must thank the chairman for handling this session so well, very rich once again. Must mention one of the best discussions that we have had on the corporate bond market. All of us in the Reserve Bank, in the government who have been associated with the financial world will tell you how the yield curves were determined before 91 and how auction systems came and changed the whole thing. And the discussion on the bond market is so rich. I myself feel whether municipal bonds can come in and bring in more instruments. The idea of the pension funds coming in and bringing in liquidity and investment, and that the movement has taken away from the commercial banks to diversified portfolio and diversified ownership. I think these are the very, very important points that we need to discuss. So I thank all the speakers. The recording, and this is going to be a very important recording. The recording will be available on the website tomorrow, and I'm sure each one of you will benefit from using it in your classrooms or sending it to other policymakers. I intend to send it to some policymakers both in the government as well as the RBI. Mr. Dubey himself is from the Northern Board of RBI. He may like to send it to the governor himself. With that, I must also mention next week we have an excellent discussion On Russia-Ukraine war, Professor Kondapuli will be speaking along with Ambassador Verma and General Rajeshwar. I think that will be an interesting session. And week after that, we have Surjit Bhalla, Dr. Virmani, and Bhasin speaking on the government's programs and poverty. And a week after that, we have Arvind Panigaria speak to us about reforms. So the next 3 weeks are going to be very interesting, and I invite each one of you to please spare an hour with us and take the benefit of the speakers that we have lined up. Once again, let me thank the speakers today. Let me thank the chairman today and the participants for enriching the discussion. Thank you very much.
Thank you, sir. Thank you very much, sir. Pleasure being here.